Most traders don't blow their accounts on bad setups. They blow them in 20 minutes after a bad setup. Think about that for a second. The entry wasn't the problem. The chart wasn't the problem. The strategy wasn't broken. What broke was everything that came after the stop-loss hit. The emotional re-entry, the doubled lot size, the setup that didn't really exist but felt close enough. The position opened not because the edge was there, but because the loss needed to be erased. That's revenge trading. And if you've been in this game for any amount of time, you already know exactly what that feels like from the inside. The heat in your chest. The justifications assemble themselves faster than you can question them. The cursor is already hovering over the buy button before your rational mind has even finished the sentence. Here's what's uncomfortable. Studies consistently show that the majority of retail traders who experience significant drawdowns trace the bulk of that damage not to their original losing trades, but to the positions they entered immediately after. Not the loss, the response to the loss. Your entries aren't destroying your account. Your reaction to your entries is. And the worst part? Willpower doesn't fix this. Motivation doesn't fix this. Watching another video about discipline doesn't fix this. Because by the time the revenge trade is forming, you are no longer in a state where any of those things are available to you. There is only one thing that works, and it's not what most traders think it is. That's exactly what we're going to get into today. Here's the belief that keeps traders stuck in this cycle for years. I just need more discipline. It sounds right, it feels responsible. You lose a trade, you take a revenge trade, you blow past your risk limit, and the conclusion you land on is, I need to be stronger next time, more focused, more controlled. And so you come back the next session with fresh determination, and the exact same pattern plays out again. Because discipline is not an input, it is an output. You cannot decide to be disciplined the moment the loss hits. That moment is too late. The neurological sequence has already started. What cognitive scientists call the amygdala hijack, the emotional brain overriding the rational brain, doesn't ask for your permission. It doesn't pause while you remind yourself of your trading plan. It moves faster than conscious thought. And in that window, the version of you that knows better is simply not in charge. This is not a character flaw. This is not a weakness. This is human neuroscience, operating exactly as designed, in an environment it was never designed for. Loss aversion is one of the most documented findings in behavioral economics. The pain of a loss is felt approximately twice as intensely as the pleasure of an equivalent gain, which means the moment your stop loss hits, your brain is not processing a neutral data point. It is processing a threat, and threats demand a response. The revenge trade is that response. It is your brain's attempt to neutralize the threat by recovering the loss as quickly as possible. It feels like urgency. It disguises itself as opportunity, and it almost always makes everything worse. Mark Douglas spent decades studying exactly this. In his work on trading psychology, he returned again and again to one core insight, that the trader's edge is statistical, not individual. No single trade proves anything, but your behavior after a losing trade, that reveals everything about whether your edge will ever actually reach its potential. The reframe is this. Revenge trading is not a discipline problem. It is an architecture problem. The solution is not to feel less. It is to build a structure that governs your behavior before the feeling arrives. And that structure has one rule at its center. But here's what most traders miss about that rule. It's not about restriction. It's about something much deeper than that. Let's make this concrete, because abstract psychology doesn't stop revenge trades. Real numbers do. Imagine a trader. Decent strategy, positive expectancy when executed cleanly, win rate around 45%, risk-reward of 1 to 2. On paper, that edge compounds beautifully over time. But this trader revenge trades after roughly 1 in every 4 losing sessions. Not every day, just once a week or so. One emotional re-entry that violates the setup criteria, usually at a larger lot size than planned, usually in the opposite direction of the original low. Run the numbers across a year. 52 weeks, 13 revenge trades. Each one averages twice the normal risk because the lot size went up in the heat of the moment. Each one has a lower probability of success because the setup criteria weren't met. Even if half of them accidentally work out, the net damage over a year is catastrophic. Not because the strategy failed, because 13 decisions were made from inside an emotional state instead of from inside a process. Now compare that trader to one with an identical strategy, identical win rate, identical risk-reward, but one difference. After every stop-loss hit, there is a rule. Non-negotiable. Structural. It doesn't matter how strong the next setup looks. It doesn't matter how clear the candle pattern seems. The rule governs what happens next. That single behavioral difference, compounded across a year, produces an entirely different account trajectory. Same edge, same market, completely different outcome. Jesse Livermore understood this, the hard way, and more than once. Livermore was arguably the most gifted market reader of his generation. His ability to read price action and position accordingly was almost uncanny. And yet he blew up his account multiple times throughout his career. Not because his read of the market was wrong, because after significant losses, he abandoned the cold-blooded discipline that made him great and started trading from a place of emotional urgency. He scaled into losing positions. He chased moves he had already missed. He let the need to recover override the judgment that made him exceptional in the first place. His story is not a cautionary tale about talent. It is a cautionary tale about the absence of a circuit breaker. Think about what a circuit breaker actually does. It doesn't improve the electrical system. It doesn't make the wiring stronger. It simply interrupts the flow of current the moment the load exceeds safe parameters. It doesn't negotiate. It doesn't assess whether this particular surge might be okay. It trips, every time, without exception. The amateur trader feels the loss, feels the urgency, and lets the current flow. The professional trader hits the stop-loss and the circuit breaker trips. Not because professionals don't feel the emotional surge, they do, exactly as intensely, but because they have a rule that trips before the behavior can follow the feeling. One rule, installed in cold blood, executed without exception. But here's what most traders never realize. The real battle isn't out there on the chart, it's in the 10 seconds after the stop-loss hits, before you've even thought about what to do next. Let's map exactly what happens inside you when a stop-loss hits, because if you can see the spiral clearly, you can recognize it while it's forming, not after it's already cost you money. The sequence moves like this. The stop-loss hits. In the first few seconds, there is a flash of frustration. That's normal, that's human, that's fine. But immediately behind that frustration comes something more dangerous, an identity threat. The loss is no longer just a data point, it becomes evidence. Evidence that you were wrong, that your read was off, that maybe you don't have the edge you thought you did. And the mind doesn't tolerate that evidence sitting there unchallenged. So it does what minds do under threat. It seeks resolution. And the fastest available resolution, the one that feels most logical in that moment, is to get the money back, immediately, from the same market that just took it. This is the moment the lot size goes up. This is the moment the setup criteria quietly loosen. This is the moment you find yourself staring at a candle formation that you would have ignored 20 minutes ago, but now looks compelling. Not because the setup is better, because the need to recover is louder. The trade gets entered. And now one of two things happens. Either it works, which is actually the worst outcome, because it teaches your brain that emotional re-entry is a viable strategy, or it doesn't work, which deepens the loss, intensifies the identity threat, and pulls you further into the spiral. This is what overtrading from a drawdown actually looks like from the inside. It is not recklessness. It is a completely logical response to an unbearable feeling, executed through a completely irrational behavior. The contrast is stark. The amateur trader enters this spiral and experiences it as a series of individual decisions, each one feeling justified in the moment. The professional trader recognizes the spiral as a single event that begins the moment the stop-loss hits and responds to it as such. Not with willpower, with a pre-committed rule that removes the decision entirely. Before we continue, if this is landing for you, subscribe. Not because the numbers matter, because you need the reminders. This is the kind of content that doesn't help you once. It helps you every time you come back to it, before a trading session. Now, here is the mechanism that makes the rule work, and why most traders who try to install a rule fail within a week. The rule only works if it is specific, pre-committed, and genuinely non-negotiable. Vague intentions don't survive emotional states. "I'll try not to take revenge" is not a rule. It is a wish, and wishes don't trip circuit breakers. A rule sounds like this: after any stop-loss hit, I do not touch the platform for 20 minutes. No exceptions. Not even to watch. Not even to analyze. The platform closes and the timer starts. This is not optional. This is the rule. The specificity is what makes it executable in the moment when execution is hardest. You don't have to decide anything. The rule has already been decided. Your only job is to follow it. Here is how you actually install this. 3 steps, specific, behavioral, in the right order. Step 1. Set your daily drawdown limit before the session opens and treat it as a market close, not a warning, not a checkpoint, a close. If your account hits a drawdown of 2% in a single session, the platform closes. You are done for the day. This is decided in advance, in a calm state, when your risk-reward thinking is clear. The number doesn't have to be 2%. It has to be a number you choose before the session, in writing, when you are not inside a loss. The act of writing it matters. It moves the rule from intention into structure. Step 2. After any stop-loss hit, mandatory 20-minute gap before any new position. No exceptions for obvious setups. No exceptions for high-conviction reads. The gap is the rule. Use those 20 minutes to complete one journal entry, not a lengthy analysis, just 3 lines. What the setup was, why you entered, and what the stop-loss result tells you about the trade, not about you as a trader. That last distinction is everything. The loss is about the trade. It is not evidence about your identity. Step 3. After any stop-loss hit, your next position, if you take one, returns to your base lot size. Not the same size as the losing trade, base size. The minimum unit that keeps your risk-reward intact without the emotional weight of trying to recover a specific number. This removes the recovery incentive from the next position entirely. Your job with the next trade is not to get the money back. Your job is to execute the process correctly. Stop overriding your stop-loss to give trades a little more room. Start treating your stop as the point where the trade's thesis has been invalidated, not the point where you decided to hope instead of trade. The rule that holds all of this together is simple enough to remember mid-session. If the loss is still in your body, it is too soon to be back in the market. You will know what that means when you need it most. I know what some of you are thinking right now. I've tried rules like this before, and I still broke them. Here's the answer to that. You broke them because they weren't pre-committed in writing, because they didn't have a specific trigger, or because you left yourself a negotiation window. A real rule has no negotiation window. The circuit breaker doesn't consider whether this particular surge is probably fine. It trips, every time. Build the rule with that same unconditional quality, and it will hold. All of this only works, though, if one deeper thing changes. That's what I want to leave you with. In the end, revenge trading comes down to this. You are trying to use the market to resolve something the market cannot resolve. The loss already happened. The candle was already closed. No position you open in the next 20 minutes will change that. What you are actually trying to recover is not the money. It is the feeling of being right. And that feeling cannot be traded for. It has to be released. If you've made it this far, you are not someone who takes this lightly. You are not looking for a shortcut. You are looking for a real answer. And the fact that you're still here tells me you already understand, somewhere, that the real answer lives inside the architecture of how you trade, not inside the next setup. Here is the shift that changes everything. You stop being a trader who needs to recover losses. You start becoming a trader who only executes from neutrality. That is not a small shift. It changes your relationship with every stop-loss you ever take. Losses stop being threats to your identity and start being exactly what Mark Douglas always said they were, the cost of doing business. The tuition the market charges for the right to participate in its next opportunity. The rule is the bridge between who you are under pressure and who you are capable of becoming. So here's the only question that matters now. Are you willing to write it down, make it non-negotiable, and hold it the next time the stop loss hits and every instinct you have is telling you to get straight back in? Subscribe if this gives you something real today. And if you know a trader who needs to hear this, send it to them. Not as a criticism, as a gift. The market doesn't reward the need to be right. It rewards the discipline to keep executing when being wrong costs you nothing but the trade.